SoFi stock just pulled back, and the market thinks this is just another fintech breather. But that assumption could be a costly mistake, because there's a part of SoFi's business that most investors still aren't valuing correctly. And if that changes, this pullback stops looking like a warning and starts looking like a setup. This isn't just about the last earnings report or a simple price target. This is about a deep structural change that many people are ignoring. In this video, we're going to break down that hidden pivot, why it directly addresses one of the biggest perceived weaknesses in SoFi's business model, and how this recent pullback is creating the tension needed for the next big move. But context is everything. This is where a lot of investors quietly get this wrong. This isn't a stock that's been bleeding out. In fact, 2025 was a phenomenal year for SoFi, with the stock delivering returns of over 90%. What we're seeing now is not a trend deterioration. It's what analysts call a constructive consolidation. After a huge run-up, a period of cooling off is not only healthy, it's often necessary before the next leg higher. Think of it like a coiled spring. The run-up in 2025 created enormous potential energy. This pullback is compressing that spring. The question is whether the fundamental business has what it takes to release that energy in a powerful move upward, or if the spring is actually broken. The bears will tell you it's broken. They'll point to some very real, very concerning risks that you absolutely need to understand. And to build a credible bull case, we have to look at the bear case first. The arguments against SoFi aren't trivial. They're significant, and they start with one word: valuation. Right now, SoFi is trading at a forward price-to-earnings ratio of around 47 to 52, depending on the day. While not as high as some claim, that is still a significant premium compared to the sector median. What this means is that SoFi is priced for near-flawless execution. There is very little room for error. Any slip-up, any missed target, and the stock could face a significant drop because there isn't a huge margin of safety built into the current price. This pressure is intensified by another factor: dilution. In early January 2026, SoFi completed a secondary public offering of over 57 million shares at $27.50 each. While raising capital is a normal part of a growth company's life, events like this, along with recent insider sales, make some investors nervous. It means the pie has been cut into more slices, making it harder to grow earnings per share. This is why the market still thinks SoFi is just a lender, and it puts even more pressure on the company to outperform. Now here's why this argument no longer tells the full story. And finally, there are the macroeconomic headwinds that SoFi can't control. A huge part of SoFi's business is its portfolio of unsecured personal loans, and that portfolio is highly sensitive to the job market. If we see any real spike in unemployment, it could lead to higher than expected defaults on SoFi's loan book, hitting profitability directly where it hurts. Now, this is exactly how the market used to think about SoFi. This is where the old story used to end. The bears see a premium price stock facing dilution and a shaky economic backdrop. From that perspective, a pullback makes perfect sense. All of those concerns are valid if SoFi were still just a lending company. But that assumption is already outdated. This is the core of the thesis, and this is where the narrative breaks down. The reason this pullback matters is because it represents a battle of narratives. The market has historically priced SoFi based on its lending story, a direct-to-consumer digital bank that makes money from loans. But a fundamental transformation is happening under the surface, shifting SoFi from a capital-intensive lender into a capital-light financial infrastructure provider. And this is the difference between investors who see SoFi as a volatile fintech stock and those who understand why institutions may start treating it like infrastructure. The secret weapon in this pivot is its technology platform segment, powered by Galileo and Technisys. Think of this as the Amazon Web Services for fintech. And most investors didn't understand AWS when Amazon launched it either. Instead of just offering services to its own members, SoFi provides the back-end technology, the digital plumbing, for other banks, fintech companies, and large enterprise platforms to build their own financial products. This business model completely changes the equation and directly attacks one of SoFi's most criticized metrics, its cash flow. For the last 12 months, SoFi has had a negative operating cash flow of nearly $3 billion, a massive cash burn that worries investors and is a direct result of the capital-heavy lending model. But the technology platform business is different. It's capital light. In the third quarter of 2025, this segment generated over $114 million in revenue. It doesn't rely on putting SoFi's own capital at risk in loans. Instead, it generates high-margin, recurring fees from its enterprise clients. This revenue diversifies SoFi away from being solely dependent on the spread it makes on loans and moves it toward a scalable, high-margin service model. This directly addresses the cash flow problem that has plagued the stock's narrative. This transformation isn't some far-off dream. We are on the verge of seeing concrete proof. There are two dates the market is watching, and both could force investors to pick a side. The first and most important is the upcoming Q4 earnings report, confirmed for the morning of Friday, January 30th. For the stock to move higher, Q4 earnings can't just be good. They have to be great, and the guidance for 2026 has to be even better. This call is where the market will be listening for one thing above all else: commentary on the growth of the technology platform. Any mention of new major partnerships or accelerating client account growth could force a rapid reevaluation of the entire company as the market begins to shift its view from a consumer bank to a regulated infrastructure platform. This earnings call is an inflection point. The second major catalyst is the potential for S&P 500 inclusion. As of late 2025, SoFi has officially cleared the major hurdles for eligibility. Its market cap is well above the required threshold, and it has achieved multiple consecutive quarters of GAAP profitability. In fact, Q3 2025 marked its 8th straight profitable quarter. While inclusion is never guaranteed and depends on a committee's decision, meeting the technical criteria is the hardest part. If SoFi is added to the index, it would trigger a massive forced buying spree. Every S&P 500 index fund and ETF would be required to purchase tens of millions of shares of SoFi stock, providing a huge liquidity tailwind that could send the stock soaring. So let's bring it all together. This recent pullback isn't just a random dip. It's the market's uncertainty made visible. It represents the tension between two powerful competing narratives. On one side, you have the bear case, a highly valued fintech company facing dilution and macroeconomic risks. On the other, you have the bull case, a company in the middle of a brilliant pivot to a capital-light, high-margin technology business that the market hasn't fully priced in yet. The risk is very real. The valuation is demanding, and management has to execute perfectly. But the reward is a fundamental re-rating of the stock. This pullback is providing a moment of consolidation before a potentially decisive earnings report on January 30th. That report will be the test. It could be the catalyst that validates the entire bull thesis and quiets the bears for good. This isn't just another dip. It's a showdown between SoFi's past and its future, and the market is about to place its bets. If this helped clarify what the market might be missing, do me a huge favor and hit that like button. It tells YouTube you want to see more deep dives like this, and it genuinely helps the channel. What do you think? Is the market right to be cautious, or is it completely missing the boat on the technology platform pivot? Let me know your take in the comment section below. I read every single one. And if you want more deep dives that go beyond the headlines, make sure you subscribe to the channel. Thanks for watching. Because if this pivot continues, this may be one of the last pullbacks the market offers without confirmation.